stocks can be multi-baggers. They can grow your money by multi-folds in short time span. But on your screen, you can see that if we can call them as multi-bagger mutual funds. So had you invested 1 lakh rupees in any of these funds, your money would have grown by at least 3 times and maximum up to 5 times. These 33 equity mutual funds on your screen have given returns of more than 25% over the last 5 years, where Quant Small Cap Fund has delivered the highest 39% returns. Most of you might be attracted to these funds, but these may not be the right investments for you. But why do I say so? Well, that is what we are going to cover in today's video. Despite massive returns, it may be better for you to stay away from them. So let's understand who should or should not invest in these multi-bagger mutual funds. If you have looked at the funds, now most of them are small cap or mid cap funds. Mid cap funds are the ones that invest in stocks which are ranked between 101 and 250 in terms of their size. And the funds that invest in stocks ranked 251 and below are called small cap funds. These funds tend to rise high and fall more. They are more volatile as compared to large cap funds which invest in the biggest companies in the country, and flexi cap funds which invest in mix of large, mid and small cap companies. Now, mid and small cap funds are meant for sophisticated investors who understand the risk of investing in these funds. However, if your risk profile and the risk profile of these funds do not match, these funds may not be the best choice for you. Now, what is your risk profile? How do you know that? Well, you can easily find it out on the ET Money app by answering a few questions for Investor Personality Assessment Test. This test not only tells you about your risk-taking abilities, but also guides you through the suitable investments. So while you must be tempted to invest in these funds, don't forget to take the Investor Personality Assessment first. This will avoid any unwanted investments in your portfolio. Now, this is the most common mistake investors make. They chase funds which have delivered high returns in the recent past. In behavioral science, it is called the recency bias. Recency bias leads one to get inspired by the recent performance in the short term rather than looking at the long-term performance trend of the fund. It might happen that a fund which is topping the charts currently may not have a good performance history. So buying a fund based solely on trailing returns of a fund should be avoided. The returns that we usually look at are trailing returns. Now, trailing returns are the returns of a fund between two particular dates, also known as point-to-point returns. They do not give you an overall picture of the funds. Now, getting back to our list of funds. They have delivered 25% plus returns between two dates, that is February 8, 2019 and February 8, 2023. Your returns would have been drastically different had you invested 1 month, 2 months or 6 months earlier or later from these two particular dates. So depending on when you are investing and withdrawing, your trailing return can change significantly. That is because of the nature of equity markets. As markets keep moving up and down, there is possibility that you may enter during a rally and exit during a correction or vice versa. Now, to give you some idea how big the difference in returns can be between different time periods, look at your screens once again. These are the mutual fund returns of the 33 funds. You can spot the vast difference between returns easily. So trailing returns are definitely not the right criteria to select the funds. Then how do you select good funds? What is the way out? Well, you will need to look at the rolling returns. Rolling returns give the right picture. Imagine this. Suppose you want to invest for a 5-year period in a fund. But before investing, you check how the fund has performed in all the 5-year time periods that could be there in the last 10 years. So between say 2014 and 2023. So what you'll have to do is calculate the 5-year return, assuming the investment date was 1st January 2014. Similarly, find the 5-year return starting 2nd January 2014 and so on till the last 5-year period between the selected 10 years, which will be from January 1, 2019 to 31st December 2023. It will show you a spread of returns had you invested on any day during the 10-year period between 2014 and 2023 for 5 years. Now take the average of these returns. This is what is called as rolling returns of the fund. So rolling returns is like calculating trailing returns on a daily basis and then taking an average of the series of returns. Rolling returns is a useful metric in knowing how consistently a fund has performed over a particular period. Now, while some of you may argue that historical returns may not be repeated in future, but those who have paid slight attention to their chapter probability during their school days would understand that as the sample size of the returns while calculating the rolling returns becomes so big that it gives a fair idea of what you can expect from that fund. Now, while it's a useful concept to understand, doing the calculations on your own may be a daunting task. Well, worry not, you need not do the math. We have done it for you already. We have taken out the best funds in different categories of equity funds to help you out in not falling for the recent outperformers. Instead, going with the funds which have performed consistently well over the long time period across different time spans. You can find the link to these videos in the description, or you may scroll through our channel for more content. Now, to give you some context, we have taken out the best funds as per the ET Money rankings, which were totally based on the rolling returns of the funds. Apart from returns, ET Money ranks also factored in downside protection. So the funds that gave a higher protection from volatility were ranked higher. So apart from the best fund videos, if you have any fund in your mind, you can check its ranking and get a complete analysis on the ET Money app for absolutely free. This brings us to the end of the video. Hope by now you have learned that the funds at the top of the chart today may not remain there always. So you need to invest in consistently good performers that protect you from volatility as well. Also, not to forget to invest as per your risk profile. But before you leave, don't forget to like and subscribe to our channel, and we'll come with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.